What's going on, everyone? I am Charles Moon, the disciple of trend, and this is my podcast, Buy High, Sell Low. Just want to mention that stock and stock options trading does involve a substantial degree of risk and may not be suitable for all investors. Past performance is not necessarily indicative of future results.
What's going on, everybody? Welcome back to the Buy High, Sell Low podcast, infotainment at its finest. I am your host, the disciple of trend, Charles Moon. Today, folks, I'm not going to give away any signals like I've done recently. What I am going to do is talk about the general strength, the health of the markets. Now, listen, the last two sessions have been a bit volatile. And it started with the FOMC meeting, right? It really started with the FOMC meeting, so to speak. What ended up happening, ladies and gentlemen, was that Powell said the word mid-cycle. Basically, he hinted towards the fact that this was just going to be a one-off event. There's no consideration. In essence, as the market took it, there will be no other further rate cuts. And the markets dropped. And I mean, when it dropped, it was down. It was about a 400, 500 point swing like that. It was pretty darn quick in the Dow. But, as he got into his press conference about maybe 5-10 minutes after the fact, he reiterated and clarified his statement and said, well, it's not saying that we wouldn't do another hike. I'm just saying there's nothing planned for this effect. In essence, it's not a predetermined rate cut and further rate cuts. And so they will accommodate as needed. That's one of the big factors, accommodate as needed. Well, the markets didn't take that too kindly, but we did start rallying back. And then all of a sudden, on August 1st, the POTUS sent out a little tweet midday. We were actually up pretty nicely, and then all of a sudden the market started dropping. We were up 1% in the Nasdaq, a little bit more, about 1.25%, 1% in the Dow, 1% in the S&P, and then all of a sudden, like half of it got shaved, and then we went negative, and then we started to extend. And once we really shaved off really quick, I said, "Oh no, there has to be a tweet out." And sure enough, we looked, and here it is. Ultimately, what it comes down to is that he was talking about the prior deal, didn't come into play. He said that China promised to buy more agricultural products from U.S. In turn, he also said that, and this was the magic tweet right here, the tariff, an additional tariff, 10% on the remaining $300 billion of goods and products coming from China. This is starting September 1st, and in turn, he also did mention that they were willing to adjust that to 25% if need be. Well, since then, since the high in the NASDAQ futures of 80.1450, we are now at 76.14.5. Quite a drop in just about a day and a half. And quite honestly, this bar right here is today's session. This is the opening print from when futures opens up on Sunday, and this has been the reaction so far. It took out the low. The low, which, by the way, held at the 50-day and closed above, which was so important because when we started a really strong breakout to the upside, it was by that definitive level acting as immediate support. So we've already traded through this level twice. We're down below this level now at the 100-day, which didn't have much relevancy before. So what's the fallout here? Well, if the markets continue, from a mathematical standpoint, we're looking at a potential 10% retracement, that ever so important correction territory. This is what we call a volume profile, similar to like a market profile, but it doesn't have the timestamps that are included. It shows the bottom end of the volume where the volume accumulation has been and distribution has been, basically highlighting institutional interest and activity. But the factor here is that if we dive bomb, we could just start rolling over towards that 73.5 level where that fatter edge of support has come into play. But there's no other technical basis besides that volume profile. The truth of the matter is that we could shoot this gap, so to speak, right? And really, that aligns with the upper edge of this volume profile, which in turn will put us at that 200 period simple moving average, which by all means could have an effect, considering that the last time they touched this level on June 5th, they hit this level and rejected higher. Now, it's not to say this would have any validity or this would have any validity, because generally speaking, market profile traders go based on contracts. However, with the volume distribution and interest, there could be a high level of interest concentrated in this particular price range. Now, the truth of the matter is, we could have a Fed member come out and say, well, we would absolutely consider this. The whole purpose of the Fed looking to cut rates was a preemptive move to ensure that our economy doesn't collapse because of the trade war, because it's going to have a residual effect. It's going to have a heavy residual effect considering how big of a trade partner China is with the United States of America. So it's a preemptive measure. And with this particular tweet and the timing of the tweet, whether it was scripted by the POTUS and the White House themselves to force the FOMC's hand, and speaking of which, he also had tweeted on Fed Powell, okay? In that instance, ladies and gentlemen, it may force the Fed's hand to have an additional cut. I don't know if this tariff would have truly come out if the Fed said we are going to make a half basis point cut, right? 0.5 BPS. And in turn, we'll consider strongly in our September meeting for further rate cuts. Now, mind you, the Fed hasn't made a cut since 2008. I believe that's the case, right? Maybe 2009. So it's been a pretty damn long time. And we're supposedly in the strongest economic state we've been in the last decade, right? Job creation is still there. Unemployment at its lowest. So why does Donald Trump want to force the Fed's hand? It's pretty clear coming from his industry or business industry that it'd be more beneficial. He believes that it'd be beneficial for the great country of the United States of America to benefit from a rate cut. And in turn, what was even more pressing in this is the fact that we're only in this situation because of this ongoing trade war. And so it seems that right now the markets are going to feel or already feel that we're just, this is never going to end. And that's the question, I guess. When will this end? When will this end, ladies and gentlemen? When will this end? When will there be a deal done? Now, I am not going to state what Trump is doing is bad for the economy. Truth of the matter is, okay, he's definitely doing it for the betterment of the United States of America. But to strong arm a deal with a country as big as China, you know, there's a stark difference between how Mexico and Canada succumbed and created this deal, albeit the last minute, the NAFTA deal, but they obviously ended up agreeing in the end, versus how it's been in terms of talks and negotiations with China. And so we continue to strong arm and we continue to get ourselves in trouble here with the broad markets, and the reaction has been extremely negative. It's the absolute opposite of what Donald Trump wants. And this was his tweet here. This literally came out after Powell was speaking. 3:41 p.m. Powell started to speak from 1:30 to around 2:30 Central Time. Okay? He's also mentioned Powell in other tweets recently, but ultimately we've seen how the market has reacted. It's extremely negative. Extremely negative. Now it's at a point where the market doesn't even care about a rate cut. Because if you look at the Fed Watch, if you look at the Fed watch, okay, we've actually jumped in terms of percentage. We have jumped in terms of percentage in regards to, in terms of a cut. So look, I'm going to pull this back in here. We've jumped to another cut. So we are currently at this 2 and 2 1/4. We are now pricing in a 98% at one point. Oh, one day it goes at 98%. Now it's at 85%. And this only went down because now a larger cut has jumped into play at 14.2%, coming in at a half basis point cut for September. Now let's look at December. It was at 26%, 50%, 22%, and almost nothing down to that 1% rate. And look at these numbers now. So the markets are now thinking the Fed is going to make this huge cut, more aggressive cuts. In fact, they're anticipating 2 more. So why are we going down? That's kind of a big telling sign here of what may come. Because usually when the markets start pricing in that rate cut, this is the move that it was making. This is the move that it was making. This was the move that it was making. Not craziness, not volatility, not risk off. And this is the thing, guys. With recent earnings like an NTAP, for example, that's hitting cloud names, right? Amazon washing out, which is hitting cloud names, the biggest momentum name out there. Dow Jones stocks unraveling, semiconductors push it on down. Banks are succumbing and moving lower. And I'll throw these all out. Look at Goldman Sachs here, right? I always throw out Goldman Sachs, but look at that drop in the last 2 days. JP Morgan the last 2 days. Look at how Amazon has performed here. I'm not trying to say there's doom and gloom in the markets, but people are anticipating immediate rebound because that's what we've had. I just don't see that happening this time around this quickly. I do believe that there's a great chance that we'll actually retrace back to this 200-day moving average. If you've noticed, we've done it already once this year. A beautiful, swift-moving, and consistent downtrend. The only issue with this is that this was very fast. This was extreme, and we've seen some of those extremes. And we had that same extreme the last time we crossed over that 50-day moving average. There was a big dispersion in between the 50 and the 100-day, whereas it's really tightened and condensed here. But that's the whole thing. We're breaching technical levels where we found technical support as recently the last time as we were there. And so that reference in terms of technical traders, historical base, was that this was a pretty definitive and key level of support. We melted through that level. It was no problem for us, for sellers to just slam through. Since I started this, guys and gals, this podcast, we are now down about 10 points in the NASDAQ futures. Look at this extension. They are on the lows. So, what does that mean for the markets? Well, that means that high-flying stocks that were up 110%, 118%, have a chance of losing 20, 30% to the downside. Again, we're seeing Amazon already down quite a bit. Let's look at Amazon and see how far they are down. From their most recent highs at, let's see, what is this? 2035. Down to 1823. It's more than a 5% drop, I'll tell you that. And that's the whole thing here, guys and gals, all right? What are we going to do in this instance? What are we going to do in this instance where the market does collapse? What are we going to do? Are we going to protect ourselves? Are we going to actually play? Are we going to just blindly assume that the markets are just going to bounce back immediately? Now, as an investor, you're going to have great opportunities to find value in high momentum names that kind of ran away from everybody. But what about those names like Amazon that people were kind of buying in at these highs, like 2000, for example? Oh, it's Amazon starting up again and it's on the move. We've been trying to short Amazon the day after it flipped the stop, ladies and gentlemen. The stop flipped on July 31st. Once that happened and Jerome Powell's speech took place and the market reaction, we were looking. We tried to short it at 1850 and didn't get a chance. And then Amazon got away from us and got all the way down to 1808. We did that because we are pretty long in my program right now. I have one short Netflix. I'm long PAGS. I'm long Team. I'm long Vive again. And those stocks all struggled. Now, PAGS came back, and we're pretty much at unch, but I don't suspect that that's going to be good. I have a feeling we're going to get stopped out of all of our longs. If not Monday, then maybe Tuesday. And if we have a chance of liquidating earlier with a smaller loss, we're probably going to have to. And now we're in this mode where we're scrambling for shorts. The problem with that is a lot of these names are still in what we would consider bullish territory. I don't just randomly short stocks. I try to never fade the strength. I try to look for the signs of weakness. And when I have these signs of weakness, which is predetermined by that ATR trailing stop, one of the most key indicators that I use. And if you don't use it, if you don't know about it, I have a beautiful webinar that I had on that ATR trailing stop. It's a difference maker. Guess what's going to happen here in the Qs, the S&P 500 and everything else? Guys and gals, these are all going to flip tomorrow. SPY has already flipped. You see that blue dot? That tells me I'm in the buy zone. It just went pink here. Verify because it closed. That's what I'm saying. We saw the signs of weakness, and now we're in a position where these trade signals that we've had were already on for quite some time, and now we're in the midst of having to do collateral damage. And so where is the predictable downside? Predictable downside means that it's going to head towards this particular price level, which is the 200-period simple moving average. When was the last time it crossed the NASDAQ? When it crossed over the 50, where was the predictable behavior? Down to that 200-period simple moving average. Here, when it crossed over, the predictable behavior was to the upside. So let's take a look at the ES, which is the S&P 500, the broad markets. The last time they got below that 50-day moving average, they tried to get above. The predictable downside was towards that 200 before they rally back. That's where we're looking at right now. Right now, the 200-day moving average is at 2791.74 in the ES. So let's just say 2800. That means we have somewhere around 100 points from where we currently are at in the ES to the downside. It's a pretty dramatic drop. It's a pretty dramatic drop, guys and gals. I mean, I don't suspect that we'll fully get there. We could even cross over and get lower. But let's not kid ourselves and say that it can't happen. It's happened once before already this year. I don't think we'll see this anytime soon, but I'll never say never. I believe something like this will happen. And that's kind of where we're at right now, that this is starting to take place. And this was the key indicator that's kind of telling me that's happening here. The Hull moving average, a momentum and trend indicator that I use, which is only yellow on this ride up until it slides through. Yellow on this ride up until it slides through is now red. Red means that the strength is to the downside. I had it starting back here in May 6th. I had this starting here in July 31st. The catalyst, the FOMC meeting with Fed Powell, sorry. I just want to say that I personally hope that the markets will bounce back. Not that I'm a permabull. However, I just know that there's going to be that ever so creeping voice of gloom and doom. Ladies and gentlemen, it's okay. It's actually a great thing that the market retraces back 10%. Better value, better opportunities. Because if the market corrects itself back higher, you have an incredible opportunity to pad your portfolio. Listen, as a trader, volatility is always a good thing. Downside movements is a good thing. Fast rebounds is a good thing. As an investor, if you loved Amazon at 2000, you should absolutely love Amazon at 1800. And I'm most definitely sure that you would love it at 1600. So it's leading to opportunities. The problem is the velocity that the market moves down. That's what scares people. 1% retracements, 1% retracements, back to back to back is going to cause some fear. Only because of what's recently happened, which was pretty substantial and dramatic. But again, when you're an informed trader, you recognize this and it becomes an opportunity. So that's what I challenge you with, ladies and gentlemen. Is this going to be a fear factor moment, or is this going to be an opportunity? As a trader or as an investor, there are multiple ways, okay, to either protect yourself or take advantage. But it's up to you. It's up to you to get out of that mentality of doom and gloom and look for the bright light, the pot of gold, the opportunity, because they will present themselves. And if they're assessed properly, they could be awesome. And I mean awesome. Now, some people are not comfortable shorting in the markets. That's fine. There are a bunch of inverse plays that you could buy into. VIX products, for example, which are highly volatile. I don't recommend them. Or inverse to the S&P 500, inverse to the Dow. Smaller ETFs, cheaper ETFs. You could buy those to hedge out. You could write options against your trade, right? Cover calls, for example, if you have an investment. There are so many different things that you can do, none of which, again, I'm going to sit here and recommend. But if you do your own due diligence and your research, you're not out there all alone, and you don't have to sit there and watch. Proactive is okay. Preemptive is okay. The Fed is trying to be preemptive, and so should you. If we move back 10%, okay, consider it a blessing. The market right now, by the way, is designed to withstand a 50% drop. No, it won't be awesome, but it's not going to cause a financial and economic catastrophe like it did the one time in 2008 when the market collapsed. It's been propped up. It's been designed to retrace back 50%. Let's just pull up the S&P 500 here, okay? Let me adjust this really quick. Let me just pull this back, okay? From where it is right now. I'm going to pull up on a 5-year chart. That means we would be back down to the 1500 range, okay? That will put us at around the 5-year lows or thereabouts. Let's even go back more. Let's go back 10 years. 50% if we were right there. 50%. That brings us to the early highs. The early highs, ladies and gentlemen, of 2012. Which, by the way, were almost double of where it was in 2008. At the very worst, quite honestly, I only see it dropping 1,000 points at the most. Now, I don't want to scare anybody. I certainly don't. When we drop 500 points in the markets, it could be pretty damn devastating. But on the weekly chart, the S&P 500 is still pretty damn strong. There's really not much to be overly concerned about. It's the truth. However, we've also never had to deal with a monster like Trump that can shake up the markets the way they can. Truth remains that if we drop that 10%, okay, if we drop that 10%, is it going to be that terrible? Is it really going to be that terrible, guys and gals? Let me clean that up. That I'm a little, it bothers me. Well, yeah, it could have an effect on others. I get it. We'll know. This will be your baseline right here, and this is kind of why I drew it out. This will be your baseline right here, ladies and gentlemen. That simple little trend line. It's been confirmed by this. So if it tests this level and breaks, where are we headed to? Well, simple target will be that 200 period simple moving average. A very key level, that swing low, will be down here at 27.28. There's a lot of layers below us, guys and gals, for support. The markets could bounce back at any given time. But that being said, we are due for a pullback, and that's absolutely okay by me. It should be absolutely okay by you. Again, as an investor, as a trader, there are multiple and incredible opportunities that are being presented. Now in the ES, you could see that trend line is a little bit different. We're actually right there, and we reacted. We reacted to it already. So we'll see. We're not at a make or break moment, but we very well could be. And it may be based on the actual broad S&P 500. It may be based on the SPY. It may be on the futures contract, which is the E-mini S&P. This is just technical. Outside of technicals, what really trumps technicals is tweets by the POTUS, moves by the Fed, and any other particular geopolitical news that could have an effect on our broad markets. That is what makes things difficult, because you're stepping through landmines, because you never know when that tweet's going to come out. You never know when a geopolitical issue will arise, and you never know what the Fed will plan on doing. All I have to say is right now, folks, do be careful. There are signs of weakness. There are some support in play. We could see that reaction. The markets bounce back, which I would absolutely love. But in that same sense, let's not count on it. Let's be prepared and recognize what may happen. We get another day or two of the markets being down, most notably tech being down 1% each particular day, 2.5%, let's say, over the 2 days, Monday and Tuesday, starting off this week. It could be a risk-off month. I mean, last year, the slide started in October, September into October. So in August, right, throughout August, we're in easy rally mode. September, easy rally mode. This is not the same. If you're wondering why, it's because we have different circumstances surrounding what's happening in the markets. That's really when the trade war news took real head to the markets. Well, we're back here and we're trading at levels, I believe, that were above those levels in last October. 28, yeah, we're about there. Yeah, we're a little bit above those levels. And we're still dealing with the same issue. So fear not, folks. Markets tend to bounce back and bounce back very strongly, as we did race to new all-time highs recently. The E-minis and the S&P 500 did poke above 3,000, first time ever in the history of mankind. And on this downside, we're still above where we were at this time last year. We may come down to revisit and test that 200 period simple moving average. We may bounce here. But if we do break through and we do get to this level and we get that very strong positive reaction, the Fed looks to make that move in September and takes an aggressive cut. And then Trump all of a sudden makes nice with President Xi. All that won't matter because the markets will be at 3,500. It may not happen by the end of this year, but it'll happen pretty darn quickly. In the meantime, folks, all I'm trying to do is prepare you for what may come. We'll have to wait and see. Right now, There's going to be a lot of industries taking it to the head. There are going to be some stocks that could withstand this heat. There's going to be some stocks that could withstand this heat. Not all of them, though. The vast majority of them will pull back. So either consider strongly looking for shorts to hedge out your position, or protect your positions and your investment. It doesn't matter how you do it, whether you take risk off, whether you just keep cash on the sidelines, you just protect your portfolio one way or the other. Specifically, that short on Netflix, I've only shorted a handful of times this year just because it's a pretty damn bullish market. You don't really want to short the easier plays to the upside. Well, we recognize the weakness and we decided to do something that we haven't done much this year, and that's short. And it wasn't an easy short. We took a short in Netflix, which is beloved, which is always looked to be bought. Yet here we are doing all right. We shorted at 328.53. I mean, we've done okay with this signal. We haven't really done all that much with it, but we've done okay. And again, it's more as a hedge. We've slowly managed our position out. It had a big bounce. Our anticipation, if it breaks through this level, is that we're going to have that 300 level to deal with. That level being 305.08, which is that swing low. So between 305 and 300, we anticipate a significant amount of support to come in. Hence, a little bit of that risk off. But if it doesn't hold and we end up going down, this is going to be, even though it's a smaller share size position, a money monster move. And again, it doesn't matter, because all that matters is that this is hedging out whatever exposure we have to that upside. Now, if you're wondering why, it's pretty simple. When the markets were strong, Netflix was finding key technical resistance, rejected and moved lower. And upon that rejection, it brought me in immediately. Some of the names that you're going to want to look at, let me just get that off screen, by the way. Some of the names you're going to want to look at here in the near term are going to be stocks like Best Buy, right? BBY, down huge on that tariff issue. $9 range. When's the last time Best Buy had a $9 range? It was from open to close, from highs to lows. Dollar General, Dollar Tree. So we're talking about BBY, DG, DLTR, FIVE is another name that's going to be affected. All of these stocks have negative setups, negative trends, or breaches of key support levels and becoming very, very bearish. All of these stocks have incredible downside from where they currently at and where they could potentially go. These are some of the names you're going to want to keep an eye on. Apple, people are going to want to buy Apple a lot. Amazon too. It's kind of already moved. Baba maybe, Baidu maybe, but those stocks have been depressed. Baba's rallied back. Baidu's obviously at the 52-week lows. NTES, EDU, Momo, WB, who knows, guys? We'll just have to wait and see. This week is going to be pretty telling for the markets. I don't anticipate it to be a great one. I know this webinar I've been kind of going back and forth, but I hope you got the gist of what I wanted to warn you about. Watch out below. If key technical levels get breached in the next 2 days, we're going to see that 200-day moving average in the broad markets. So in the SPY, the 200-day currently is 278.69. It will be slightly higher on Monday, but let's just say right around 278 to 279 as of now. The Qs, which is the ETF for the NASDAQ, that's at 175.63 for now. So 175 to 176. And then the DIA, the ETF for the Dow Jones, that's at 255.62. So 255, 256, maybe even 257. All key technical levels. The Dow, by the way, the DIA actually rejected and found some support at that 100-period simple moving average and did its best to try and close at above that 50-day moving average. Well, that 50-day moving average is 264.85. It closed 264.81 just below. Yeah, it may be just 4 cents, but from the technical perspective, it closed below. It's going to test this 100-day here. The last time it tested this level, it found that immediate support at the 50 and shot up to new all-time highs. If it fails to hold, we know what's going to happen. It's going to that 200 period simple moving average. Last time it failed to hold that 50-day period, that's where it went. Look at the Qs. Last time it failed to hold that 50-day period, it went straight down. It actually blasted through that 200-day, but immediately rebounded back the following day. What about the SPY, guys and gals? Same, and same. I don't know. We'll see. I mean, we could easily just rebound back and go to all-time highs by the end of the week. I just don't see it coming this time around. This is the one time that I think the markets may struggle for gains in the near term. I'm not speaking gloom and doom. A little retracement is what the market needs. As long as we stay above this level, I'll feel absolutely comfortable for the continuation of the uptrend for the rest of the calendar year. We get below that level, we're looking at a full-on retracement, potentially to the downside. All of this is wide open space for sellers to go after. I don't think it's going to happen, guys and gals. We're in for a higher low. It should come into play at that 200-day moving average. Time will tell. Maybe more negative news comes out. Maybe things get worse and it has no choice but to go lower, it being the markets. But if it's just where we're at right now that the markets have digested the news of the tariffs, now that we can anticipate potentially more rate hikes coming into play right now, rate cuts coming into play right now, it'll be back to business as usual. We'll just have to wait and see. But guys and gals, tell me what you think. Send me that message at podcast@prospertrading.com. Email me any questions you may have. Drop it in the comments below. Tell me, will the FOMC look to make another cut this year? Will we get one more, two more? Will it be a quarter point each? Will they get aggressive and get that half cut? What about trade wars? Is there any chance that we have a trade deal made? Or is it only going to get worse? What are your thoughts? Personally, me, I don't think we make a deal for quite some time. I don't think we're just going to continuing leveraging our positions and they're going to leverage their positions. At some point, it's going to bottom off. And it's going to be just a staring contest. I do believe the Fed is going to be preemptive and look to be aggressive and accommodating. And the markets shouldn't fall further than that 200 period simple moving average. If it does, that swing low, the low in the markets that was taking place on June 3rd is going to be very important across the board. Because if we make a lower low, we may be in trouble then. I'm not going to worry about it until it happens. For now, looking for that bounce to take place sooner than later, but not tomorrow. We'll just have to wait and see. Ladies and gentlemen, I want to say thank you. Thank you for tuning in. I hope this was informative. Again, let me know what you think down in the comments below. Follow us on our socials at Prosper Trading and myself at Disciple of Trend. Would love for you guys to tune in and see how we're looking at the markets. And hopefully we could continue to help you become a better and more informed trader. Take care, everybody, and see ya.
Don't forget to like, comment, and subscribe. Also follow us on our socials, Facebook, Twitter, and YouTube. If you have any comments or questions, you can email me, podcast@prospertrading.com. Thanks, everyone.